Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand how we're currently positioned and also what we see on the global landscape. You know, not a lot has changed over the last month or so from a lot of my weekly video updates. Economy, generally speaking, in the U.S. is fairly stable, getting slightly better, and so is the job market. Not fast, never fast enough, or never to most individuals' liking, but it is getting slightly better. I continue to look overseas, especially in the emerging market economies of China, of Brazil, of India. All of these countries appear to be really starting to reignite some of their higher growth targets they saw a few years back. While their economy slowed a little bit over the last couple of years, let's say from a GDP growth of 10 or 8%, maybe down to 6 or 7, which is phenomenal. It looks like there's some reacceleration going on there. We're seeing a little bit of a lag in the last 30 days or so on the emerging markets against other base U.S. index. And I ultimately believe that's one of the reasons why we're seeing that is people are basically continue to plow money into what they perceive to be one of the safer equity areas, which tends to be the U.S. Even though the U.S. ultimately is probably not going to be the big recipient of the outstretched returns that the emerging market economies can give. We continue to shy away from traditional kind of fixed income investing. In fact, we've got a couple adjustments coming up, and we continue to add to our preferreds. We continue to own our emerging market debt. We continue to shy away from long-term treasuries and municipal bonds. I think there are just so many investors out there that plow just tons and tons of money into these general areas. One of the bond funds that I talked about just a few weeks ago is the PIMCO Total Return Fund. And I talked about why large, giant mutual funds really are going to probably be lackluster performers. While that particular fund that I mentioned a few weeks ago has a great manager and historically has done an excellent job, the problem is the law of large numbers eventually work against each one of these funds. I've seen it happen in my 27 career in the investment business. And the PIMCO Total Return Fund and the other PIMCO funds that just have too much money in them, ultimately I believe, will lag their base indexes because they can't be as nimble. Ultimately, with the low interest rates we have, and I think eventually you're going to see some slight tick-ups in interest rates. Nothing shocking immediately, but stabilization of rates from going down and maybe a slight uptick on the upside is really going to have a very, very negative impact on general bonds, individual bonds, especially intermediate and long term. Again, that's one of the reasons why we get away from these areas. We continue to look at the preferreds. I made a comment earlier. We've looked at a lot of the global bonds outside the U.S., which really historically have much better yields than what the U.S. has. And we're also looking at mortgage REITs, which is another area that we've added to some of our income-oriented accounts, because again, I feel that ultimately we're going to see probably much better returns or income coming out of investments that are alternative fixed income investments, not your traditional bond investments that most people would assume that you would invest in for income purposes. So there's ways to escape the low interest rate environment. Not that you're going to look for some grandiose 15 or 20% dividend players out there, but ultimately there's better places to park your money than in an ultra large mutual fund that's going to be very lackadaisical in my opinion, and it's going to be very slow to move. You want the speedboat that can maneuver in an environment like this, not the giant battleship. As I made a comment earlier, there's a lot of key data that's coming out over the next couple weeks. I look at earnings in the U.S. primarily over the last 3 weeks, and it's been phenomenally good. So most companies, over 70%, actually are beating their earnings estimates. And I think as we get into further in this year, not that we're not going to see some volatility, folks. We're going to see that. You're always going to see volatility in any investment sector, not just stocks and not just bonds, but you're going to see volatility across the board. I ultimately believe that we're going to see a little bit of an uptick in the second half in the U.S. And I think ultimately that's going to translate to even better growth opportunities in a lot of the emerging market economies. Europe, generally speaking, has stabilized, and there's not a lot of great things going on there, nor do I think there will be. So we're going to basically continue to be in our relatively stronger areas that we see in our global tactical. We're going to make adjustments as necessary within our disciplined strategy. And remember, folks, risk management is an important part of what we do, but there's still going to be some short-term volatility across the board. If you're a client and you have questions about your portfolio, please call the office. If you're not a client and want to become a client, please call our office for a consultation. We always like adding new clients who are nice people to do business with. And one of the things that I want to put out to everybody, if you have a group that you would like to have me come and speak to, whether it's throughout Florida or other parts of the United States. We always like doing speaking engagements for larger groups. Contact our office if you have a group that you would like me to speak at and talk about the economy, the investment markets, and how real investing works. Make sure you have yourself a safe and profitable week. We'll talk to you again next week.